Hi. This session I'd like to talk about the place we usually go to get the raw data that we need to invest, which is accounting statements. I'm not a great fan of accountants, but at the same time, much of what I need for investing comes from accounting statements. So I'd like to focus on what you can extract from accounting statements and perhaps take a financial perspective of exactly those same statements. Here are the broad questions you need to have answered when you sit down to assess a company. When you look at a company, you need to know what are the investments they've already made and how valuable are those investments. What are the growth what growth potential do they have and how valuable is that growth? On the other side of the balance sheet, you like to know how much they owe and what the equity in the company is worth. So, generically, when you sit down with financial statements, there are lots of questions you need to answer to, but broadly speaking, those answers can be boiled down to how profitable are you, what do you own, what do you owe. So let's start with the three basic financial statements that you're probably going to find pretty much anywhere in the world on a company. The first is the balance sheet, which summarizes at a point in time what a company owns, what it owes, and what its equity is worth. Then you've got the income statement that reports for a period, a year, a quarter, what the company made, what were its profits, what were its revenues, expenses, and profits for that period. And finally, there's a statement of cash flows where the accountants tell you first what the cash flows were from operations, what they were from investing, and they were from financial activities, and the net effect on the cash balance. So what I'd like to do is take each of these financial statements, talk a little bit about the accounting perspective on these statements, and give you an alternate view of what I'd like these statements to provide me. Let's start with the balance sheet. We all have seen accounting balance sheets. Of course, they are classified into assets on one side and liabilities on the other. Assets are classified usually into fixed assets, land, building, equipment, machinery, with a heavy emphasis on the tangible part of these assets. The second is current assets, which would include things like inventory and accounts receivable, maybe cash, and maybe other current assets. Then you've got financial investments, which are investments in other companies that you might have made. And finally, you have intangible assets. Sounds fancy, but in an accounting balance sheet, the most common intangible asset is usually goodwill. Goodwill is really not an asset, it's a plug variable. And the reason I am so cynical about goodwill is for goodwill to show up in a balance sheet, a company has to go out and acquire another company. In other words, if you're the greatest company in the face of the earth, you've never done an acquisition, you will not have goodwill on your balance sheet, which casts as a lie the notion that goodwill actually measures something significant. So goodwill is often the intangible asset you see on the balance sheet, but that's the accounting view of assets. On the liability side of the balance sheet, you got current liabilities, accounts payable, supplier credit, deferred taxes, deferred salaries, other current liabilities. You also have short-term debt and short-term portion of long-term debt under current liabilities. You have long-term liabilities, which would include bank debt, corporate bonds. You have other long-term liabilities, which can include underfunded pension obligations, healthcare obligations, a list that gets longer each year with new accounting rules. And finally, you have the accounting measure of what the equity is worth, shareholders' equity. So that's really, again, a plug variable that makes the balance sheet balance. So with that perspective, let's look at some of the principles that underlie how accountants think about putting numbers in a balance sheet. Again, this is my perspective on accounting, so feel free to disagree with me. Accountants, at least the traditional from traditional accounting, seem to have an abiding belief in book value, historical cost, as opposed to a current value. So if you look at the recorded value of a building or land or a fixed asset on a company's balance sheet, it doesn't usually reflect what that asset is worth today, but what the company originally invested in that asset and what it's invested in it since. But it's not an updated number. The second is accountants seem to distrust market value. Even though we have a movement towards fair value, accountants still fundamentally seem to distrust markets. They'd much rather come up with an estimate of an asset value on their own rather than use a market value, which actually makes it very difficult for accountants to truly shift to fair value accounting. And the third is, and this again might be my bias, but accounting has this bias towards being conservative. They'd rather underestimate the value of an asset rather than overestimate it. They'd rather overestimate the value of a liability rather than underestimate it. So if they're going to make a mistake, they can say, let's make it in the direction of being too conservative. I might not be fair to accountants in the way I've characterized balance sheets, but that's the way I see accounting. So when you look at a balance sheet for a company, especially an older company, you have to be very clear about what you're seeing. You're not seeing what that company is worth today, but you're seeing what that company has invested over time. You're seeing the consequences of history. And that's true not just for the assets, but what you see as the recorded value of the equity in a company. That's why for older companies, what you see as the equity might bear little or no resemblance to the true value of equity in the company, the true value of the assets. But as I noted, there is this trend towards fair value accounting that's moving across the world. And if it in fact does succeed, there is at least this belief that accounting balance sheets will start reflecting values closer to what those assets are worth right now. I won't hold my breath for it, but that's basically the accounting balance sheet. I actually have a different balance sheet in mind when I think about a company, and this is a financial balance sheet. In a financial balance sheet, notice there are only two items on the asset side: investments you've already made as a company and investments I expect you to make in the future. Investments you've already made as a company, not a problem, but basically I'm going to think of them in terms of what are they worth today rather than what you invested in them. Growth assets are tougher because this is what I expect you to do next year, 2 years out, 5 years out, 10 years out, forever. And I'm attaching a value to things you haven't even done yet. But when you buy growth companies, you do that all the time. And in a financial balance sheet, I'm essentially bringing them onto the balance sheet. On the liability side of the balance sheet, notice there are only two items: debt and equity. There are only two ways you can fund a business. You can either borrow the money or use your own money. You can slice this and dice this as much as you want, but everything you do has to go into one of those two buckets. This simplifies my view of the world. So often what I will do is take an accounting balance sheet, which comes right out of the financial statements, and try to convert it as best as I can to a financial balance sheet, because this fits my perspective on investing and valuation a lot better than an accounting balance sheet does. We'll return to this theme as we go through different investment philosophies, but you're going to see a financial balance sheet show up often as my vehicle to talk about different investment philosophies. Now let's talk about the income statement. The income statement is for a period. The balance sheet is for a point in time. So the income statement can be for a year, for a quarter. But here's how accounting income statements are broken down. You start with revenues. You subtract out operating expenses. You come up with operating income. You subtract out financial expenses. Then you subtract out taxes. You come up with net income before extraordinary item. Then you have extraordinary items, which can be losses or profits. You can have accounting changes causing income changes and preferred dividends, and you end up with net income to common stockholders. So revenues minus operating expenses, operating income, minus financial expenses, minus taxes is net income before extraordinary items. Then you have everything that comes below it. Now, if you take a look at what drives accounting income statements, it's two base principles. One is the notion of accrual accounting. In accrual accounting, you have to record transactions as they happen. So if you sell something on December 30th, you have to show that as revenues this year, in that calendar year, even if you haven't been paid yet. As opposed to cash accounting, where you record things based on when you get paid and when you pay them. In accrual accounting, you record transactions. You record revenues when the transaction happens, and you try to record all those expenses associated with those revenues, even if you haven't paid for them yet. So accrual accounting is the required form of accounting for most publicly traded companies. The second is accountants do make a big deal about how they categorize expenses. As you saw on the previous page, operating expenses are what you subtract out from revenues to get to operating income. And operating expenses are supposed, at least in theory, to include only those expenses associated with this year's revenues. So it'll include things like labor, materials, things that go directly into producing benefits only in the current period. Financial expenses are expenses associated with the use of debt. So if you borrow money, interest expenses are financial expenses. We can argue that there might be other financial expenses as well, like leases. And then you have capital expenses. Capital expenses, defined generically, are expenses designed to create benefits over many years: land, building, equipment, machinery. And here's what accountants do. Operating expenses go into the income statement right below revenues. Financial expenses go below the operating income to get from operating income to net income. Capital expenses go onto the balance sheet as assets, but then get depreciated or amortized over time, and that depreciation or amortization is treated as an operating expense. These boxes do matter because what you see as operating income and net income for a company can be very heavily influenced by which box an expense is put into. So when you think about measuring how profitable a company is using accounting statements, here are some of the things you can do. You can measure how big the profit is. Looking at the absolute profit itself is kind of meaningless because big companies are going to make more money. That's a kind of a given. So what you're going to do is you're going to scale the profit to something. So here are your choices. You can scale the profits to how much you've invested in an asset. So if I take my net income and divide it by the equity invested in the asset, I come up with return equity. If I take the net income and divide it by the operating income and divide by the capital invested in a project, which includes equity and debt, then I come up with a return on capital. But both measures, I'm scaling my profits to what I've invested in a project, with what I've invested being defined in accounting terms. I can also scale my profits to revenues. I can divide net income by revenues, which gives me net margin. I can divide operating income by revenues, which gives me operating margin. And just to add another layer of complexity, I can compute my operating income after taxes or before taxes, which can give me different numbers. I know there are other measures of scaling as well. I've seen people scale profit to assets, profit to employees. You can divide profit by pretty much any number to come up with a scaled version. Now, if you look at measuring leverage using accounting numbers, you can look at the debt that you have as a company relative to either just the equity or to the overall capital, which is debt plus equity. You can use book values or you can use market values. Basically, you can get very different numbers. But that tells me how much I've borrowed relative to the total equity or capital. I can also look at how much my debt obligations are relative to my capacity to service those debt obligations. I can divide the debt by my earnings before interest, taxes, depreciation, and amortization. Basically, if I have a lot of EBITDA, I can carry a lot more debt. I can also look at what my operating income is as a multiple of interest expenses. That's the interest coverage ratio. Again, by combining what the information I have on an income statement and a balance sheet, I can look to see how levered my company is. But one of my problems with accounting earnings is that classification we talked about of expenses into operating, financial, and capital expenses is not always consistent. Accounting, as you know, it was designed for the old-time manufacturing company. If you bought some land, you built a factory, you sold goods and services, accountants are happy as hogs. But if you start a technology company, they're not quite sure what to do with you. So your biggest capex, which is R&D, is often treated as an operating expense. If you start a retail company and you lease a store, they treat that as an operating expense rather than a financial expense. So I'm going to argue that to get a truer measure of true financial earnings as opposed to accounting earnings, we have to fix some of these mistakes. In fact, I'm going to focus on leases and R&D because they are by far the most common mistakes. But much of what I say about these two items can be extrapolated to other items just like them. So let's start with leases. Here's how leases work. If you're a retail firm and you want to open a store, you go to somebody who owns a mall and you say, look, I'd like to lease a store for the next 12 years. And the guy says, sure. You have to pay me $1 million every year for the next 12 years. That's your lease commitment. When you sign that contract, you've agreed to contractually make that payment every year for the next 12 years, right? That payment is tax deductible, and if you fail to make that payment, you're going to lose that in that leasehold or store if you fail. And if you fail on a bunch of payments, you might go bankrupt. Well, that looks to me like debt. So I've never understood why there is even a debate about whether lease commitments are debt. The question is, what kind of debt is it? So if you give me a company with lease commitments, even though accountants right now treat lease expenses as operating expenses, here's what I'm going to do. I'm going to treat the lease commitments you've entered into as the equivalent of debt commitments. I'm going to take the present value of those lease commitments and discount them back to today using your pre-tax cost of borrowing today. So if it costs you 4% to borrow money today, I'm going to take the present value of your lease commitments. Incidentally, for U.S. companies, you should see these commitments in a footnote to the balance sheet. Even if you have a non-U.S. company, you'll often see the equivalent information. These are the commitments these companies have entered into, and you have to discount them back to today. Once you discount them, you essentially have the debt value of leases. You're going to add that onto your conventional debt, and that's going to be your total debt in the company. But you're not quite done. Because you converted lease expenses from operating to financial expenses, you have to redo your operating income. What do I mean by that? The stated operating income right now is after lease expenses. And since lease expenses are no longer operating expenses, I'm going to add the lease expense back, and I'm going to subtract out the depreciation on the leased asset. Because basically, if I convert lease commitments into debt, I'm creating an asset which I now have to depreciate. So I'm going to subtract out the depreciation. Which means when I capitalize leases, here's some of the things that are going to happen. My debt will go up. If you take retail firms and you look at the conventional debt on the balance sheet, you're getting a small slice of their true debt. Capitalizing leases will quadruple, triple, make their debt go up tenfold. Second, your operating income will generally go up. When you capitalize leases for a retail firm, it'll have higher operating income than it did before. So you'll have more debt, more operating income. The net income should be unaffected because all you've done is moved an expense from above the operating income line to below. So instead of having a lease expense, you're now going to have an imputed interest expense and a depreciation expense that actually add up to roughly the amount of the lease expense. So your net income should be unaffected. And your return on capital will generally decrease because if you're a retail firm and I capitalize leases, the debt will go up substantially, which means your denominator will go up. And since even though I adjust your operating income up, it's not going to go up by as much as the denominator go up. So for most retail firms and restaurants which have big lease commitments, the return on capital will become lower when I capitalize leases. And that's part of the reason I'm doing that, to get a better measure of whether this company is in fact taking good projects. What about R&D? Let me give you my rationale for why R&D is a CapEx. My definition of a CapEx is it's an expense designed to create benefits over many years. R&D is an expense designed to create benefits over many years. Again, accountants may say it's too uncertain. That doesn't fly with me. Just because a capital expense is uncertain doesn't make it an operating expense. So I think we need to capitalize R&D, and to do so, we need to take 3 steps. First, you need to specify a period over which you're going to capitalize the R&D. In other words, how long does it take between the time you do R&D and a commercial product emerges? So if you're a pharmaceutical company, that might be 10 years. Once you've specified that life, I'm going to go back and collect the R&D expenses every year for that life. So if you have given me a 5-year life, I'm going to get the R&D expenses every year for the last 5 years. Why, you might ask? If R&D has a 5-year life, I've got to write it off over 5 years, right? So my R&D expense from 5 years ago, I'm writing off the last 1/5 this year. R&D from 4 years ago, I'm writing off 1/5. I have 1/5 left over. I keep track of both those numbers. How much I'm writing off this year, that's going to be my depreciation for the year. And how much I haven't written off, that's going to show up in my balance sheet as an asset. So here are the consequences. When you capitalize R&D, your operating income will generally increase unless your R&D is not growing at all. If your R&D is growing fast, your operating income when you capitalize R&D is going to go up because you're going to add back the R&D expense now, which you subtracted out, and subtract out the depreciation, which is going to be lower than the expense because you're growing. If you're a stable company and your R&D expense is not growing, your operating income will not change very much. Your net income will also change because R&D expense is a capital expense. It's not on your income statement, so it's taking it out of the income statement. Your book value of equity will go up because that capitalized research asset is now going to become part of your book value of equity. And for most companies, pharmaceutical companies and technology companies, which have big R&Ds, the return on capital and equity will generally go down when you capitalize R&D. That again is the reason you want to capitalize R&D, because you want truth in advertising. You want to make sure that when a company tells you its return on capital is 15%, it's truly 15%. Which brings me to the final accounting statement, which is the statement of cash flows. And if you look at statements of cash flows, they have 3 parts to them. First are operating cash flows. There you're going to find net income, and you're going to find the changes in working capital. Second will be will be the cash flows from investing. That's where you're going to find investments you make in land, building, equipment, your capital expenditures. You're also going to see acquisitions there. And you might also see some messy items that don't quite fit into either capex or acquisitions. And if you go to the third piece, you're going to see cash flows from financing. What is that? That's going to include cash flows from debt, which means if you borrow money, cash comes into the company. Cash flows to debt, which is repayments of debt, short-term as well as long-term. And cash flows to and from equity. What am I talking about? I'm talking about dividends and buybacks as cash flows to equity, and new stock issues as cash flows from equity. So a statement of cash flows counts all cash flows in and out. You're just keeping track of how much cash is left in the till. So the objective of the statement of cash flows becomes explaining why the cash balance of the company changed from last year to this year. That might be interesting, but from a valuation perspective, the statement of cash flows is a useful place for me to go, but I'm not interested in explaining changes in the cash balance. I want to look at the cash flows I had available, either as an equity investor or as a business, which means dividends and buybacks are not cash outflows to me, they're cash inflows to me. So that's the basis for why you might want to adjust the cash flows for those flows. So what you see in the accounting statements might not be a good reflection of what you would like to see as cash flows. So, in summary, look at the accounting statements, the balance sheet, the income statement, the statement of cash flows, but then use the information in a way that is relevant to you as an investor. You learn accounting statements by just using them. There is no reading about them doesn't quite help. So pick up 10 financial statements, go through them. It's amazing how much you learn each time you take a financial statement. That's about it. Thank you very much.